Hey everybody, welcome to trade part 4. This is another export example, only in this case we're going to look at what happens in our market when the foreign country puts a tariff on our exports. Again, I'm going to skip a lot of the algebra. I'm just going to show you a couple of answers and a picture. If you're having a hard time figuring out how I get these numbers, I would advise you to go to the trade part 1. It might be instructive for you. So, here's our scenario. We got our supply and demand curve. We still have the same world price as 170. That's one we had in part 3. But now we're going to introduce a tariff where the other country charges a $10 tax on every unit that we export to them. And that has the effect of lowering the world price because the world's not willing to pay as much for our product anymore. And it lowers it to the world price minus the tariff itself. In this specific example, we're talking $160, 170 minus 10. Now at this price, our quantity demanded goes up to 40. Our demanders know that our sellers can't get as much money elsewhere anymore. The price goes down. We respond by buying more of it. And so our quantity demanded with the tariff is 40. Our quantity supplied with the tariff, sellers face lower prices, is 70. And so what happens? Our exports go down, and our consumers are going to be benefiting at the expense of our producers. Consumers are going to consume more and at lower prices. So let's show the consumer and producer surplus now. Consumer surplus, everything below demand, above the price they pay. Let's see, half times base times height, that's going to come out to 800. Producer surplus, everything below the price they receive and above the supply curve. Half times base times height, it's going to be 4,900. And so we get a total surplus of 5,700. Now you might be wondering about all this stuff up here. Well, that's just deadweight loss in our market. Now, if you remember, in the part 2 video, where we put a tariff in an import market, we actually divided it up, where there was some portion of it that was tax revenue, and this bit was deadweight loss. Well, that's still happening. Well, the difference is that this yellow square is someone else's revenue. That area for the tax, those dollars collected, are not in our market. They leave our market. This area is not something that we collect as a transfer. It's something our market loses. So, I mean, yeah, it's collected by the other group, but that's not us. So this is the flip side of tariffs. Both the importing and the exporting countries, when there's tariffs, have suffered deadweight losses. And that's about all I got for you. So I hope this was helpful to you. If not, too bad. Oop, I forgot to write the deadweight loss though. How much did surplus go down by? It went down by $375. There, now I'm done. I hope this was helpful to you. If not, too bad. Good luck somewhere else. Thanks for watching, guys. Happy econing.